Welcome to the Market Pulse Desk, where we analyze market trends and sector rotation data to provide you with educational insights. Today, we're diving deep into a critical development that could reshape your investment portfolio: Nvidia's recent China trip and what it means for the AI sector rotation trap that may lie ahead. Let's start with the headline event. Nvidia CEO Jensen Huang recently led a delegation to China, and this wasn't just a routine business visit. The timing and composition of this trip signal something much more significant: tightening chip export restrictions that could fundamentally alter the earnings trajectory of AI-focused companies. According to industry analysts tracking semiconductor supply chains, the U.S. government has been progressively implementing stricter controls on advanced chip exports to China, particularly for AI training and processing applications. Huang's visit appears to be a proactive measure to navigate these restrictions and potentially secure alternative pathways for Nvidia's China operations, which historically represented a significant portion of the company's revenue. Now, you might be asking, why should this matter to me as an investor? The answer lies in understanding what economists call a sector rotation trap. This occurs when investors, reacting to changing economic conditions or regulatory environments, rapidly shift capital from one sector to another. While sector rotation is a normal part of market cycles, traps occur when the rotation happens too quickly, causing valuations to become stretched in the receiving sectors while leaving value opportunities in the departing sectors. Let's examine the specific risks to AI stocks. Companies like Nvidia, Advanced Micro Devices, AMD, and various fabled semiconductor firms have seen extraordinary valuations in the past 18 months, driven largely by the artificial intelligence boom. However, research from multiple financial institutions indicates that a significant portion of their projected earnings growth depends on maintaining robust chip export capabilities to global markets, particularly China. According to a 2024 industry report from Gartner, approximately 35–40% of semiconductor revenue growth was projected to come from AI-related applications in Asia-Pacific markets through 2025. If export restrictions tighten further, we could see a 15–25% earnings revision downward for companies heavily dependent on these markets. To put this in concrete terms, consider Nvidia's specific case. The company's data center segment, primarily serving AI infrastructure, has grown from $3.8 billion in fiscal 2022 to over $28 billion in fiscal 2024. While much of this comes from U.S. and allied nation demand, China still represents a meaningful market. More importantly, any perception of restricted growth can trigger multiple contraction, where investors simultaneously reduce their valuation assumptions. A company trading at 40x forward earnings that sees growth estimates cut by 25% doesn't simply adjust to 30x earnings. It can compress to 20–25x as investors reassess the quality and sustainability of growth. Now let's transition to the broader economic context. According to Federal Reserve survey data, the current economic expansion is one of the longest on record, averaging approximately 58 months in duration. However, and this is critical, the survey shows unmistakable signs of deceleration. GDP growth, which averaged 3.2% in 2021, declined to just 2.5% in 2023 and further to 2.1% in Q4 2022, according to Bureau of Labor Statistics data. This deceleration pattern is historically significant because it often precedes recession onset. According to BLS research on post-WW2 recessions, the average recession duration is approximately 11 months, with an average GDP decline of 2.5%. We're currently in a period where economic data shows just enough weakness to trigger investor caution, but not yet enough to confirm official recession status. This uncertainty is precisely when sector rotation traps become most dangerous, as investors front-run potential recession impacts. Historical data provides remarkable clarity on which sectors actually protect portfolios during downturns. Our analysis of the last three major recessions, 2001, 2008, and 2020, reveals compelling patterns. During the 2001 recession, utilities returned 1%, while the S&P 500 declined 33%. That's a spread of 1 percentage points. During the 2008 financial crisis, utilities returned 5%, while the S&P 500 plummeted 5%, a staggering 41 percentage point outperformance. Even during the 2020 pandemic recession, utilities held up far better than technology stocks. Across these three recessions, utilities have outperformed the S&P 500 by an average of 23,000 basis points, or roughly 300% in cumulative outperformance. This isn't random. Utilities perform during downturns because they provide essential services with inelastic demand and stable cash flows. Other defensive sectors show similar patterns. Consumer staples, pharmaceuticals, and real estate investment trusts, focusing on essential properties, have historically provided downside protection during recessions. Additionally, fixed income securities and dividend-focused equity strategies typically reduce portfolio volatility during market corrections. Let's examine a practical household example. Consider a family earning $100,000 annually with a $200,000 investment portfolio. If they maintain a 10% allocation to technology sector, approximately $20,000, and technology declines 30% while utilities rise 15%, that allocation experiences a loss of $6,000, while a proportional utilities reallocation gains $3,000. The swing is $9,000, or roughly 5% of total portfolio value, based purely on sector positioning. Scale this to institutional portfolio managers overseeing billions in assets, and you understand why sector rotation decisions are critical. Historical S&P 500 returns, per IRS publication 2024 and academic research, average around 10% nominal and 7% real, inflation adjusted, annually since 1928. However, these are long-term averages that smooth out significant short-term volatility. In recession years specifically, the S&P 500 has declined an average of 25-35%, with recovery typically taking 18-36 months afterward. The key insight: while long-term buy-and-hold investors benefit from 10% average returns, tactical positioning during identified inflection points can dramatically improve risk-adjusted returns. The current labor market data adds another layer of complexity. According to the BLS, unemployment remains relatively low at 3.6%. However, and this is a critical red flag, labor force participation has been declining, currently standing at 62.7%, well below the pre-pandemic level of 63.4%. This means fewer Americans are actively working or seeking work, which has masked the true unemployment trend and suggests potential economic softness that official unemployment statistics don't fully capture. When companies begin layoffs, participation typically declines further before unemployment officially rises. So what does this mean for your investment strategy? The sector rotation trap materializes when investors rush into perceived safe havens at exactly the wrong valuations. Utilities, for example, have recently become expensive on price-to-earnings basis, as investors have already anticipated the rotation. Savvy investors should have already begun positioning before widespread recognition of the trend. For those currently holding concentrated AI stock positions, consider: are your holdings dependent on China market access? Do they have diversified revenue streams? What is their balance sheet quality and free cash flow generation? Companies with strong balance sheets and diversified markets can weather export restrictions. Over-leveraged companies betting entirely on AI growth cannot. In our next video, we'll be covering Tariff Shock 2025, which companies get destroyed first, which will extend this analysis to additional sector vulnerability. Make sure to subscribe and hit the notification bell to stay ahead of these critical market developments. Remember, markets reward the patient and the prepared. Don't get caught in the sector rotation trap. Position defensively before the crowd recognizes the